Joining us for Wenzel's Weekly Wrap, of course, is Mark Wenzel from the Hopkins Group. Good afternoon, Mark.
G'day, Michael. How are you this afternoon?
Great, thanks, mate. Now, I see a 100-year-old engineering contractor, Clough, was placed into voluntary administration.
Yeah, absolutely. They had an agreement with an Italian company which fell through, and subsequently the board obviously put the business into administration. But the collapse will have some impact on Australia's biggest engineering projects, including the Snowy Hydro 2.0 and the $3.3 billion project Energy Connect, which is connecting electricity between South Australia and New South Wales. I mean, these are really important projects for Australia and will impact the transition to clean energy in the future. So, I mean, the falling over of Clough is going to have massive ramifications for all infrastructure projects and engineering projects in Australia. And the costs of future projects will rise as a result of Clough going into administration. Fixed price contracts are the cause of the company going into administration, and clearly, obviously, with the prices rising so quickly, they weren't factored into the price of these projects, and it's going to have an unexpected impact in the future, really. And I think the pricing of future work will have to incorporate some flexible component for these price increases. Otherwise, companies are going to have to put in massive margins in order to cover themselves against potential future price rises. Thankfully, for those working at Clough, they have been sort of given jobs in other organisations through their partners and other contractors.
Okay. And now, speaking of rising prices, the RBA rates have done it again, 8 in a row.
They're 8 in a row. I saw a graph during the week, and it's certainly one of the fastest rising cycles, and certainly in magnitude. I mean, and obviously it hadn't been as low as it was at 0.1%, and it's now 3.1. So it's a massive increase in 8 rises, and that 25 basis point increase will add another $72 a week to a $500,000 mortgage. The rationale from the RBA was that the inflation is too high, even though the latest inflation data showed that inflation fell to 6.9% from 7.8% registered in October. I mean, they're talking tough on inflation, and I think that's all part of it. The RBA chairman, Philip Lowe, highlighted there's a changing narrative potentially with the impact of previous rate rises yet to be felt by many borrowers due to the fixed rates. And we've sort of spoken about this before, that about 50% of the rate rises so far have actually flown through to customers because so many had fixed rates. That's expected to move to about 70% by March, and then obviously rolling off over the next sort of 12 months after that. So it is the RBA is aware that some of these rate rises aren't being impacting the consumer just yet. But with the worsening global growth outlook and rising global growth rates, I mean, it's a real sort of important to consider, I guess, from the RBA that they put up the rates. But, it's my view that the rates are not required. I mean, I think the pace of interest rate increases is as severe as it's ever been. And, household indebtedness is as large as it's ever been. And I believe, the RBA continuing to raise without sort of pausing is putting the economy at great risk of recession. And the short-term focus, I think that they're so short-term focused, and I think also, due to the loss of credibility that they had when they said that they were going to keep rates at 0.1% till 2024, is really impacting their decision. So they want to be seen to be talking tough and getting credibility back. I think it's a mismatch between what's actually happening in the real economy and what's potentially going to happen once the rises start flowing through, than the credibility that they're achieving at the moment.
Yeah, well, thankfully, we get January off because the RBA obviously needs their Christmas holidays. Hopefully some of this will have flowed through before they come back and give us another whack in February.
Yeah, I hope so. But again, it's driven sort of largely by financial markets, not really what's happening on Main Street. And I think they're making policy errors again.
Now, oil's dropped to its lowest level since December.
Yeah, well, again, potentially another positive for inflation dropping. So yeah, it's down to $74. West Texas Intermediate, and it's well down from its peak of 120 in July. So, I mean, you know, if you remember the time in July, we weren't expecting this. I mean, the market commentary at that time was that Europe was going to be in a severe issue due to Russian gas not coming through, and that they'd be, you know, short of oil and prices were going to be really high. So, you know, having that not eventuating, because Europe's been able to scramble for gas, I think certainly the weather so far hasn't been as bad as what they thought it could be, and you know, demand, I guess, has not been as great as previously thought. The falling oil prices is a great news story for the global economy, because again, obviously, it takes some of that pressure off inflation and reduces the need potentially for the central banks around the world to continue to raise interest rates.
The proposed price cap on Russian oil at $60 a barrel, will that have any effect?
Yeah, I mean, again, I think obviously it sort of means that there's less demand for that Russian oil. So I mean, I think, you know, again, Europe's done a pretty good job scrambling to get supplies from other areas and LNG and, you know, other sources of energy. Obviously, nuclear is sort of coming back on and all of that sort of thing. So, you know, it's obviously, you know, it's trading higher than that $60 at the moment, the 74. So, you know, obviously sort of people, you know, Russia not getting any more than $60 a barrel for the oil and all that sort of thing is going to be positive for sure.
Great. Now, Glencore, global resource giants, warned us about copper shortage.
Yeah, so you know, again, I think there's been a lot of commentary in the markets about lithium and the benefits for lithium with the electrification and the energy transition. But what sort of is missed is a little bit of copper, and Glencore have reiterated that view. I mean, copper's essential like lithium in that energy transition, and certainly a major component in batteries. But the reason it's down, I think, is, again, because of the global growth outlook's pretty poor, and copper's a proxy for that global growth outlook. But, you know, what they're forecasting is a shortage of 50 million tonnes between now and 2030 of copper. So, I mean, you know, with the market predicting the deficit, but in their view that the copper price is not reflecting that deficit at the moment. So potentially, obviously, for listeners, is if they want to play the energy transition theme and obviously the battery theme, maybe copper is a better commodity to look at, and certainly find some producers of copper that may benefit from those price rises between now and 2030, when you know, supply shortfall is going to be massive. And again, just like you know, it takes a long time for mines to come online. So, you know, even if you find a significant copper resource today, you know, it's 7 to 10 years before it comes into supply. So, you know, I certainly think that demand is, you know, seriously outweighing supply is going to see the copper price rise in the future.
Right. All right. Well, Mark Wenzel from the Hopkins Group, thanks again for the wrap up.
Michael, good to speak to you.